Hello and welcome to ETCFO. Today we have with us Hitesh Sawhney, who is the partner of Corporate Tax and International Tax PwC. Hello and welcome, sir.
Hello.
So, what we wanted to understand is, last year budget government announced about e-assessment implementation. So, what we wanted to know is that, how has the implementation been so far and what has been the major challenges?
The current round of assessment is still on a historic e-assessment where there is a lot of communication on an email and a portal. Therein we have seen that there are challenges in respect of the amount of information you can upload, the understanding of that information by the tax officer, because sometimes even though we have submitted information, we got a call from the tax officer to come and explain what is being submitted and also to produce the documents in physical copies, because those are not downable and everything. So those kind of challenges which we have seen.
How much do you think that it's going to reduce the harassment that everybody has been, because of which it has been implemented?
It's a step in a right direction, because rather than one individual person, there are a group of people which are looking at your cases. There are checks and balances within the division, because one is a person who is verifying the file, the other is a person who is interacting with the taxpayer from a email communication also. So there are different people. So we are hopeful that it will ultimately achieve the objective of reducing harassment, reducing even the corruption for that level in the tax department.
So it's still wait and watch.
It's still wait and watch. It's very early stage to comment upon whether it has achieved its ultimate objective or not.
What are the major direct tax related implications in India that impacts foreign investors?
See, the first and the foremost was the corporate tax rate, which the government thankfully has rationalized 6 months ago to a rate which is very competitive amongst the developing countries. I think the foreign investor is also looking for a relaxation in the DDT, which is a dividend distribution tax. It adds on to it because they are not able to claim a credit in their home jurisdiction. It is an additional tax paid by the Indian company from their sake. So their demand has been consistently to go back to the taxation in the hands of the shareholder rather than taxation in the hands of the company distributing it, because first they are able to have a lower rate which is generally applicable in the international community, either in a 10 or a 15%, and more importantly, they are able to claim a credit in their home jurisdiction. So which makes their overall tax cost at a certain level. It avoids double taxation. Second, I think there has to be a clear certainty on the investment side. I think foreign investor is looking for a investor-friendly place, infrastructure for doing business. I think the government in the last budget announces that they want to make certain plans for the big manufacturing to shift. But that was only an announcement. What did the government has done after that? Have they identified? There has to be the entire infrastructure for them to really do that kind of work. I think that is where they look for the government help to create that infrastructure so that they come and do ease of doing, whether it's an import, whether it's an export, whether it's an accessibility of that market or things. So that is where I think from a taxation point of view, apart from this DDT, the other thing which the foreign investor is look at the certainty and reducing the litigation process in India. In India, the litigation takes around 12 to 14 years to achieve. We have a tendency of litigating even on the smallest of issue. Even if the taxpayer wins at the case, tax department files a case against the next level. Thankfully, last August, they have increased the limit, which was a lower limit now to a reasonable level of 50 lakhs, 1 crore, 2 crore, depending on an appellate authority, that the tax department is allowed to file an appeal. So there is some rationalization there. But then also there is a huge number of pendency of the cases. Like I was reading a thing that there is almost like 4,85,000 cases on the direct tax side which is still pending, and majority of them are with the CITPs, more than 3 lakhs. So somewhere they can have a mechanism to reduce that. Somewhere they can have there is a big ask for a dispute resolution to work in an effective way.
Do you think that Sabka Vikas scheme, which is there for the indirect taxation, is a way forward for direct tax as well?
The real optimism about this Sabka Vikas scheme was the ability of the government to accept certain adjusted ad hoc payment against the past litigation, which has never we have seen in the direct tax. If the government can bring in a similar scheme with a similar framework,
with incentives,
with certain incentive, like there is an interest but not penalty, or there is a reduced penalty. I think penalty should be avoided at all, because the moment you say penalty, people will not be. But if you can avoid the penalty part of it, you would see this will go a great way in a success. Specifically, as I'm saying, the large number of cases are with the CIT appeals. There could be a big push by the taxpayer, because even if they win, there is a possibility of department getting into litigation. If they're getting a window to get that case settled by making certain payment, they would be more than willing to accept it and resolve the litigation.
What are the key issues for the CFOs to move to the corporate tax reduced rate regime?
So I think the key implication was, as against the original regime, was certain companies were availing certain higher depreciation, accelerated depreciation, certain tax incentive. Some of the Indian companies were paying under MAT, and they had a huge accumulated MAT credit, because these were the three main detrimental to get into the reduced rate. So they had to just do a kind of an exercise that on a 5 to 10 year horizon, which is more beneficial for them. What my interaction with few of the CFOs, when they did an exercise, because it appears to them that okay, having a credit, it was good, but when they did on a live business simulation, they were actually figuring it out that the new regime is more beneficial. So they wanted to give away even the credit, MAT credit, which they have, because on a 5 to 6 year horizon, this was more beneficial coming out to be. Second decision which they also have to make, because there is another window which is for the new manufacturing plant.
Yes.
And ironically, if you see, that benefit is available only for a company incorporated after 1st October 2019.
Yes.
So some of them, if they have an existing company, have the funds in the existing company and set up a new plant in that, they will not be eligible for it. So the decision of whether to go for another company, and if at all, then how to go about it, how to get the funding of that. So that is another decision making which they are looking at. But I think both of them have an attractive proposition, because 17 rate is a substantially lower rate even as against the 25% rate.
Sure. So they're still considering it and weighing
I
their
think everybody
options.
is in the drawing board to see if people are investing, that whether to go for it. I think the problem is right now that people have hold on to their investment cycle because of the fear of the slowdown and everything. So somewhere there has to be some incentive on an investment side also.
True. Thank you so much for your inputs.
Thank you.
Thank you.